Welcome to the webinar. I am Sara Waqar and I'm a prop trader and an educator of the financial markets since the last 12 years. And my main areas of interest are currencies, commodities, and stock derivatives. I'm licensed from FINRA in USA and from SCA in the UAE. I've been running professional trading courses since the past 10 years with people of all different backgrounds to build a stable approach to the markets, focusing on trading opportunities, risk management, and trading psychology. I've also been involved in financial journalism where I've investigated different types of financial fraud schemes, such as Ponzi schemes, which has given me a deeper insight into how this industry works and what should be the best practices. Welcome to Amana. We are a brokerage with 15-year track record of delivering excellent performance to our clients and a very good overall trading experience. We have our own app called the Amana app, which I'm sure most of you must have downloaded by now and must have tried it. If you haven't, then I will ask you to please download that app because it's an excellent app and it has everything inbuilt in the platform, including all fundamental analysis, news releases, as well as access to so many different asset classes, such as international stocks, regional stocks, currencies, commodities, indices, ETFs, and then there is also an option called Amana Invest, which is a program in which you can invest in ready-made stable portfolios that don't require management and that can steadily build long-term returns. So if you have any questions during this webinar, there is a Q&A section below, and please post your questions there. Do not post them in the chat. So because I cannot see the chat, I can only see the Q&A. And I will try my best to answer them. If you want to reach out to us, you can email us at support@amana.app, or you can contact us through the website. You can call us, you can chat with us on our live support on our website, or you can contact your relationship manager. So today's topic is something that, is my favorite topic, and I'm not just saying it just because it's today's topic. It really is the favorite market of mine in which I trade. And as we go through the course of the webinar, you will understand why it's my favorite market. So today's webinar is about stock indices. And I know that everybody knows what stocks are, what equities are, but some of you might not be familiar with what a stock index is. So what is an index? So an index is basically a group of stocks bundled together. Imagine you wanted to know how healthy the US corporate world is or how healthy the US economy is. Instead of checking different companies individually, you create a basket of the top 500 companies by a certain measure, for example, by their profit or revenue or market capitalization. So you create a basket, and that basket becomes a stock index. So that index is like a benchmark which is used to measure overall performance of the market. It's like a scoreboard for the economy or for the stock market. And you can compare this index to something like a team, a cricket team, instead of one individual player. And every player has their own performance. Or you can compare it to something like a fruit basket. Instead of checking on every fruit individually, you have an entire basket of different fruits. And that is something which it's a very simple example. Perhaps it's too simplistic, but I always quote it as an example so that it makes it very easy for beginners to understand what is an index. So indices, so plural for indexes, indices. So indices act as macro indicators. They are often, for initially, you might view them as something complex, but actually the concept is very simple. Before you get into trading individual stocks or you start looking into how an individual stock is performing, you need to first look at the broader market. You need to understand how to measure the overall market before you get into individual stocks. And that is where the stock indices become important. So the index, depending on how it is measured and depending on how many companies it includes, becomes a reflection of a whole industry or it becomes a reflection of a whole economy. And most indices that we are going to talk about are very diversified. They have a lot of companies included in them, and these companies are like the mega giants of the world. They lead the world in tech and in other different areas. And when we look at the composite of these companies and how that total is performing, that number becomes a representative of the economy. It becomes a representative of investors' confidence, of corporate growth, of capital flows, of the market psychology, all combined into one number. So an index is like a scoreboard for the stock market. And instead of tracking hundreds and thousands of variables of each company individually, an index allows you to look at the broader picture through a single number or through a single benchmark. And this is the reason why, traders, even if they are, studying individual stocks and hedge funds and central banks and economists, everybody is paying so much attention to the stock indices. They are not just watching a number, they're watching the health of the entire economy. So, as I discussed, as you can see, these indices are a reflection of the inflows of risk appetite, of consumer confidence, because they contain all the broader, they're reflecting all the broader macroeconomic variables within them. And one thing which will put you at an advantage if you are trading an index is that if you're trading a company, you are not diversified. Even though if it's a big company, if it's a tech giant, even then there is some company specific risk related to, for example, say the earning report is coming, so the company's share price is going to be very sensitive to that. And there can be so many other examples of company specific risks. But if you are trading this index, then that is actually insulated from individual forces or individual negative factors. So this is one very big advantage if you are invested in an index. And depending on what type of index it is, you do get a lot of diversification. Yes, it's not complete diversification because it's not, you still have risk of the market. You still have risk that certain maybe macro factors might work against you. But when it comes to more company specific risks, those are diversified and removed if you are trading an index rather than trading individual stocks. So now we're going to talk about my favorite market and the favorite index, which is the S&P 500. Now, the S&P 500, you must have heard about it. It's the most important and widely followed index in the world. So it consists of the top 500 publicly traded US companies by market capitalization. And it covers 80% of the US equity market. So 80% of the value of the US equity market, which is over $15 trillion, is reflected by this one number. So this number is actually very important because it is simply telling you how America is doing, how the world's biggest economy is doing. And this number is the best representative of the stock market, of the corporate growth of that economy. So simply, if the S&P 500 is rising, it means investors are optimistic, capital is flowing in, the economy is growing, the confidence is increasing. And if it is falling, that means panic. That means the recession. It could mean, the economy is slowing down. So it's as simple as that. So now let's try and understand this index a little bit more about how it has behaved in the past and why you could benefit a lot from trading this index. Now, as we've spoken before, this index has the top 500 companies included in it, but the weight of that companies is not the same. This index is a market cap weighted index. So what is market capitalization? It is the share price times the number of shares. So it's basically the value, the market value of each company is different, obviously, and it will have a weight according to its market value, which means that the biggest companies will have more weight in the index and the smaller companies will have less weight in the index, right? What is the present situation right now is that a few companies largely dominate the S&P 500, which are called the Magnificent Seven. And I know that, many of you must be aware of that. Why do these companies dominate the S&P? So let's first look at who companies are these. So we have NVIDIA, Apple, Microsoft, Amazon, Meta, Alphabet, and Tesla. So these are the Magnificent Seven, which are actually, they comprise 33% of the index, and the remaining 493 companies comprise the other 67% of the index. And that has got to do with the sector and the work that these companies are doing. So these companies are connected to artificial intelligence. They are the pioneers of AI, of cloud computing, of semiconductors, social media, and digital infrastructure, which are the main themes of the world right now, and where we are seeing the maximum growth, right? So yes, these companies form a very big chunk of this index, and that is not ideal because that does mean that, if there's a change in, any of these companies' valuation, it will skew the index. But still, when that is the case, we still have plenty of diversification within this index. So, and we know that nowadays everything is driven by this mega cap technology and AI investment, and all, the institutional flows and everything is concentrated around AI, right? So if we are to look at the exact weightage, NVIDIA has the most weightage right now with 7 to 8% of the index, and then Apple is 6%, and then Microsoft is 5%. So as compared to other companies like Walmart or Oracle, which are less than 1%. So if you want a list, if you're curious to know which companies are there, you can find the whole list online. Okay. And yes, another insight about this is the top 10 companies account for over 1/3 of the index, which is again, risky as well, and it has opportunity as well. So let's go to the platform now and look at this index. Okay, now I'm going to show you S&P 500. So S&P 500 actually, there's more than one way to trade the index. Now I am going to try to be as clear as possible. An index can be traded as an ETF, as an exchange traded fund. It can be traded as a futures or as a CFD or spot. Okay, so these are various ways to trade the index, and in all cases, the price is quite similar. And so I'm going to first show you the spot S&P price. So this is the S&P 500, which is the spot index or the CFD. And right now, this index is trading at 7,353, right? So now this number, 7,353, is not the number of companies in this index, and it's not how much one company is equal to. It's basically an aggregate score of all of these companies combined. And the way that you can think about this number is it's like having a big company which includes all of these 500 companies within it, and the share price of that company is $7,351 per share. This is just a way of thinking about how to interpret this number. It's not actually like that, but it's a way, it becomes simple when you think of it in that manner. So talking about three ways. So first of all, when we talk about ETFs, exchange traded funds, it's the most simplest way of investing in S&P. So exchange traded funds are actually, are traded just like shares are traded. They're listed on the stock exchange, and you can just buy shares of the exchange traded fund. Now you need an S&P based ETF, a pure S&P based ETF, and you can sell the share, buy and sell these ETF shares throughout normally on the stock market, and that is the closest thing uh, to actually owning the underlying stock in the index by trading it through ETFs. So that's essentially ETFs are essentially like a ready-made basket containing pieces of these 500 companies, and you do have ownership of the underlying companies in that case, in the case of investing in S&P through an ETF. And some ETFs also pay dividends while other will reinvest the dividends. So your returns are compounded. But in this case, when you trade on the platform, you will not. So actually, we do have an ETF as well on the platform. Not everybody offers it, but we have it here at Amana, and it was SPY. So this is the ETF, and its price is going to be it's going to be different because it's measured in a different way, but it maps the S&P. And usually it is non-leveraged. Here, there is a slight bit of leverage. As I was checking this before, if I scroll down, there is a 1 to 2 leverage. But you can, if you want to just trade the ETF without leverage, you can request it for the leverage to be completely removed. Then the second way is to trade it as spot CFD, which was the chart that I was showing you earlier. So don't get confused. It is just slightly different instruments of the same prices, or the prices are very close to each other. Just remember that an ETF, you can choose not to have any leverage, but in case of trading it as a CFD, which is this one, or as futures, which is this E-mini SP6M instrument. This is the future contract of S&P 500. So what is the difference between this and this? What's the difference between the future and the spot? So in futures, you are trading a contract based on where the S&P might move in, might be in the future. So this is the June's future contract price. So the futures are mainly used by professional traders and by institutions because they allow traders to control large portions using leverage. So we can use leverage here, which means that you can use small amounts to have bigger positions and to create larger profits, but that can also lead to larger losses. And futures are going to expire after some period. So they have an expiry. So if you click here on this, and yes, so this expires on June 18th. So if you have a position here, your position will close on June 18th and you will have to reopen the position. So if you are trading in futures, the advantage is you will not have any overnight swap charges. So because those charges are built into the price of the future contract. So if you want to open a trade and hold it long term, it's better to trade this future because you will not be charged the overnight swap fee. But if you want to trade this S&P SPX 500, this is the spot price. This is designed more for short-term trading. So this is a CFD, a contract for difference, which means that you don't own the underlying companies or the index itself. You're just trading a instrument which is mirroring the price of the index. It's just mirroring the price. And if you can short it as well, you can go long on it as well. It's an instrument based on leverage, but you will have to pay the swap charges or overnight fees if your position is open for more than 24 hours. So if I have to take a really longer trade, then I will usually trade this. And if I have to keep my positions overnight, but if it's if suppose the expiry of this is nearby and I don't want to have that stress of wanting to roll it over. And I know, okay, my trade might be achieved in maybe 10 days, or or less, maybe 6 7 days, and I can kind of the financing or the overnight charges will not be that much. Then I go for this. Or if I want smaller trades, like shorter trades, intraday trades, then I will go for the this. So I hope that I have tried my best to make myself clear. So now we will be looking at. I will just be working with this chart for the spot. So the most interesting fact that I want to tell you about S&P is that most people don't know it, but for the last 150 years, since the inception of the equities market, this index has been giving an annual return of 10% since the past 150 years. And that raises so many questions in one's mind, like how and why and what are the reasons behind it. So right now I just have the charts going back to 23, but if I had the charts going back 10 or 20 years, the graph looks the same. It looks like an uptrend throughout. Yes, it has its dips, and those dips, since we were on the weekly, these are significant dips, and they were caused by, major events like the global financial crisis or the COVID. But as you can see, the market nicely recovered from these dips, right? And for if I look at the last 20 years, which is more relevant, then the return was around 11% if we add the dividends. So if we add the compounded dividends in the return, then it's 11%. And that is more than than any interest rate that you receive on your savings. So why is this? Why is this that S&P has been giving this much for so long with such consistency? Now, if anybody knows the answer, can you write it in the Q&A? Does anything come to your mind that why is this market so persistent, so resilient? What explains it? Why has it been rising? Why has it been overall bullish? Can anybody try and explain? Does anything come to your mind? No? Okay. Maybe because it has blue chip stocks, Heather. Okay. Jad, because they are selecting the top 500 companies. Yes, this is one of the answers. You are very close. Ahmad is saying, is it because of crisis? Yes. Okay, so the first reason for this that I can explain is, sorry, let me go back. Yeah. Okay. First of all, you have to understand that S&P is not a savings instrument, right? It's representing ownership in some of the world's largest companies. Somebody is saying top 500 companies as well as consistently rising GDP. Okay. 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 Regarding expiry, I request more explanation. I will come to that towards the end. Okay. So when you are investing in S&P, you are basically investing in the world's largest and most profitable companies, right? Over time, these companies are growing in revenue, in earnings, in innovation, in market value, and that is driving the stock prices higher, right? So the S&P is benefiting from long-term economic growth, from corporate expansion, from technological advancement, from productivity gains, from everything, right? And the reinvested dividends. Yeah. So Jad said, your answer is the closest. The first thing you have to understand is that S&P has this self-correcting mechanism with which it is built, because it is taking the top 500 blue chip companies, which means that any company which does not make it to the top 500 or which falls below is automatically weeded out of this index. So that is a very interesting thing. So in a way, what the index is doing, it is doing the stock selection for you, right? And it is getting rid of the underperformers. So whichever are the top 500 companies, so this is an evolving index. The companies are not like static or stagnant, right? Another, okay, so let me elaborate a bit on this point. So if you looked at the composition of S&P before, if you went to the 1920s, we had, what was the basic theme which was leading the progress? It was electrification. Then post World War II, it was this industrialization. Okay, these companies made it to the top, right? Then in the 1980s, it was the introduction of the computer. Then it was the internet. And then we know that the internet kind of brought the kind of changes that nobody could even dream of. And then all the top companies had, the internet embedded in themselves, like in however they used to manufacture or sell or manage, whatever. So the productivity gains flowed directly into their corporate earnings, and from the corporate earnings, obviously, into the stock prices. And now, what is the main theme? The main theme is artificial intelligence. So the companies which have made it to the top of the index are those companies like Nvidia, or which has now 3 trillion market cap, and then Microsoft, Google, and Amazon, Meta, and all of these, right? So any productivity gain will flow, which is flowing through the companies, translating into its higher earnings, and then further translating into the S&P, right? So the thing is, you have to understand that with this, if you're trading this index, you're not picking who is who is winning and who is not winning. You simply need to invest in the index, that this index will automatically rotate towards whoever is at the top, right? So it made that way, it is constructed in that way, and so it inherently ensures that kind of exposure. This and the other thing that we need to understand, which is very interesting, is, like I said, S&P is reflecting the technological advancement that we as a human race are experiencing. Like in every decade or in every era, there is a certain theme, right? And that theme is the one which is bringing the most progress, and which is bringing the most earnings, the most profits, and that keeps on changing and evolving. So what the S&P is doing, it's soaking in that theme and those progression, those productivity gains, those earnings, by the way that it is constructed, right? And this is the reason why it is always in a bull run, because of this stopped anywhere, despite so many recessions, despite the world war talking about, despite the we had the dot-com bubble in 2000 to 2002. Despite that, it recovered in, I think, 6-7 years. That was the longest recovery it made. But then in the financial crisis, again it dipped and recovered in, I think, about 5 years. But in COVID, we saw that the recovery was very, very quick. It was 4 to 5, the dip which came in the COVID, which I can just show you. This one here on top. Yeah, so this was just took about 5 months. And why the volatility has increased so much and why the recovery has increased so much is something that is very an interesting to look at. That, why is it that, this, if a dip comes, or if, certain kind of, you can say, pullback comes, doesn't it take so long now for the market to recover? So this is beyond the scope of this webinar, but in my next webinar, when we will look into the details of the correlations between different indices and how they have and why they have performed in a certain way during crisis, I will also be talking about the volatility. What has happened to the volatility over time? Why is it that the volatility has increased so much? So, and yes, quickly, another reason is the reinvestment of dividends, that mainly, like, when dividends are usually reinvested in the S&P 500, which kind of compounds the returns. So that kind of increases the returns as well. So yeah, these are the top reasons why the S&P is so resilient. There are one or two other reasons as well. I'll give you another quick one. It's the inflation and the debasement of currency, which is a continuous process. So it will go on forever, as we know. Like, what was cost us $100 5 years ago, it's maybe now costing us, I don't know, 120 or so. The value of the is going to increase, in my opinion, because even if for the companies, even if the real market share and the volumes and everything remains unchanged, only because the currency is depreciating, the prices are going to rise, and the corporate revenues are measured nominally. They are not measured in real terms. So we will see, this is one of the reasons why we will continue to see in like the S&P inflate. Let me now move on. I need to really, cover other things as well. So apart from the S&P, we have other major indices like Dow Jones, which covers top 30 elite companies, which are these traditional American companies like the oil giants, which are like banks and industrial firms and consumer brands. And because it is not that diversified, it just has the 30 top companies, it's more slow. And it's it's like traditional corporate America. Coming to NASDAQ 100, which is a very interesting index. So this is, remember, this is not NASDAQ composite, it's NASDAQ 100. So this is like the technology index. Its composition is the top 100 non-financial firms. So by non-financial, we usually mean the top tech firms. So it's quite tech heavy, and because of that, it tends to move the fastest because the tech stocks are growth focused and they are more volatile. So when investors get excited about like AI and innovation and growth, so the NASDAQ 100 actually does move even faster than S&P. FTSE is UK's top 100 companies. It's the UK index, and all these three belong to the US. So the UK's version, this is the of a major stock index, and it tracks the 100 companies in the UK and is more influenced by energy and more influenced by banking and mining rather than tech. So if we look at, if you want to trade these as well, we have all of them on the platform. I have here is spot, and then this is the future, right? So yeah, if you look at it again, it's very correlated to the S&P. So the NASDAQ and the S&P have a correlation of about 90 to 95%, which is definitely, it's a very high correlation. And yes, then there are questions to mind. Okay, then what should I trade? Should I trade NASDAQ? Should I trade Dow Jones? Should I trade S&P? So for that, I think it depends on your preference. But please remember when you trade them that they are very highly correlated markets. So if you're opening a trade in all three, that does not really mean that you're diversified, because you might actually, if the market moves against you, you might actually get stopped out in all of your positions. So just remember, when you are trading highly correlated market, like you're trading gold or silver, or you're trading this, it's a better strategy if you're trading speculatively and in the same direction, right? So you're confident about a certain move. You're confident that, okay, S&P will go up. And so you say, okay, NASDAQ will also go up and Dow will. If you're getting three similar positions, please remember you're not diversified and you're increasing your risk. So if you're going in with 2% risk everywhere, essentially you have a 6% risk on the same kind of position. So when you're doing your risk management, you need to keep these things in your mind. If you have some other strategy, something like you're trading some convergence. So sometimes there is these indices can move and converge in, a way that is abnormal, and then sorry, they can diverge in a way which is abnormal and then come back to their and they can revert to the mean. So if you have such a strategy, then that's different. Then you're not exposed. I'm going to talk about more about divergence and all that in the advanced webinar, which is on Thursday. But here I'm going to about more about introduction to other indices. And please also remember, there's one interesting fact about NASDAQ, that it's the leading all the indices. So if you see a movement, you would record it first in NASDAQ, and then the S&P will respond, maybe perhaps not with this intensity or not with the same percentage change, but there is a lag, there's a lead lag relationship, which is quite obvious. Dow is the slowest to respond. So Dow is, okay, where is Dow? This is the future contract, mini Dow future. And don't think we have What? Yeah, we just for Dow, we have this one. Let me search. No, we have this, we have June, and we have, yeah, we have the US 30. So Dow is also known as the US 30. So this is the spot price for Dow, which is right now 49,576, right? So if you were just to observe one interesting thing, if I go to NASDAQ, I'm on the like very close to the ever high here, right? So we had a really bullish run in the past few weeks, right? And we're at this peak. And but if I go and if I see how Dow has behaved, so it is right now lagging. It has not beyond its peak. And this is what I mean by the lead lag relationship. So yes, and if you want to ask me what like how we can trade this right now, so I can share my opinion with you, which is that if I look at this market, the first thing that I always look at is the market structure, and I make my bias according to the structure. So this is a bullish market, and in my opinion, because it's a strongly bullish market, I don't usually go short in such a market, right? Even though you might argue we are at the top and it looks like the market will really come down. So everybody actually has their own way of thinking and their own strategies. But when it comes to me, especially with the indices, I don't like to short them. Why? Because they have been trending up, since before we were born. So this is such a heavily bullish market, and I would usually, because I'm like a long-term swing trader, mostly this is my trading style, I don't go short. But yes, if you have a good reason, if you have a really strong price action at a point where you think the price can dip down and you can get significant risk reward, then yes, if you have the right reasons, you've done your risk management, you can go short perhaps. So what will I do here? After observing the bullish trend, what I will do is, the second thing is for the prices, you wait for the prices to return to a certain level. In case of an uptrend, that will be a pullback. Now, what we see right now is the prices have not pulled back significantly. They are looming on the ever highs. So I would not advise, if you want to go in as a buyer, this is not the right price. This is not the right price level, although this is a very good, strongly trending market. And this is the reason why I said this was my favorite market, because of the way that it's very easy to read. It is very clearly trending. And if you get major dips and if you're able to, uh, you know, get in at the time of those dips, then your gains can be quite significant. And the thesis that I have told you behind that is, again, why the S&P will continue to move upwards. I have just explained that. So what I mean is that after the dips, if you're able to, kind of recognize the bullish price action here and get in somewhere around here, these are the best places to get in, and to just kind of ride this rally, right? So we had so many places. So we had this tailed bar here, which I talked about. This kind of price action reflects upward price pressure. So after a dip, this is a very nice entry. Here we have an inside bar. Again, this was a very nice entry. Prices pulling back and giving you some confirmation of buyers coming in, right? This was a very nice entry, and I did trade here, by the way, and I gained over 1,000 points. And then, yes, this was a bit tricky because we don't have very clear price action, but still we do have, after many days of bearishness, we have bullishness here. So this again reflects end of the dip. So these are good places to get in. So now, just letting you know what would be a perfect trade for me. A perfect trade for me is, first, I would like the prices to come down to levels where I'm comfortable to buy, which would be somewhere around here. Sorry, so that's the previous support level here or close to this. And here I would wait for some kind of confirmation, some kind of strong bullish price action. And that is, in my opinion, a very good entry to go long. So now moving back, I'm just going to quickly show you other indices. So this is FTSE 100, which is the UK top 100 companies. The correlation with S&P is there, but not that strong. So it's 60 to 80% depending on what the economy is going through, because this economy is more reliant. Like FTSE is more reliant on the pound, as well as other factors like the policies of the Bank of England, and this index is dependent on the mining sector and on other sectors, which mining as well, and construction and such other sectors. So it's not like it's not also a very fast moving index as well. But again, if there's a considerable divergence between S&P and this, if the divergence is more than like the usual 60%, then there is a trading opportunity, because we know that this will eventually but slowly converge back to those levels. So yeah, this is more of like an advanced strategy for traders who have been observing these indices for some time. But the simplest way is again to like, which I explained to you earlier in S&P, just ride the trend, right? And yeah, so if you want to go in NASDAQ, go in NASDAQ, leave S&P. If you want to go in S&P, leave others. Or if you want to go in all, then please take care of your like risk management. You need to be aware that there's move similarly. So you have to adjust your risk accordingly. One interesting thing is that when you go down on the platform here, you see these performance measures, right? So this performance, so if I've selected NASDAQ here, on the top, then the performance will be reflective of NASDAQ, right? These figures. And as you can see, in the past 1 year, it has gained 32%, which is a phenomenal figure. So this is without any leverage. If you had just, traded at the nominal value without leverage, right? That's actually a very big return. And I think it's a kind of return that not even funds or any other saving scheme or something is giving. So we need to understand that this is one of the best markets to be in. This is the one of the best ways to make money. It is just to get and ride these, bullish indices, right? And like I said, even if you're not using leverage as a beginner, even then these gains are substantial. And if you are, let's assume even if you used twice, like I'm assuming that somebody has held this index over a certain period of time, over a year, right? That's what I'm assuming. But this number is just has to give you an idea of how good this market is. And this is why this is my favorite market. It's just easy to trade, and you can have both short-term positions when you get in the dips and long-term positions if you want to hold long-term. You can do both of that, right? And imagine only using 3 times leverage on this over a long period of time would have given you 100%. So holding it long term, maybe using twice or thrice a little bit of leverage would have amplified these returns. You don't have to use a lot of leverage. How do you reduce leverage? By reducing your position size, right? And whenever you use leverage, again, we have to do the risk management, like I explained. You have to have a stop loss, even if it's a very wide stop loss, you have to have your risk calculated. Dollar risk should be calculated on that trade, and position size calculated according to your dollar risk and stop loss size. So we have other indices. So this is DAX, which is the German index. Okay, the top 40 German companies, and CAC, which is the France index, top 30 France companies. So again, not gonna go into a lot of detail, but I'm just introducing these indices to you. And so if I look at the returns, the CAC just produced about, because it's very zigzag. It's not it is overall very slowly trending upwards, but it's not like it's a very slow trend. It's not a fast trend. It's managing to make higher highs slowly, but it's nothing like the S&P. So over a year, it's just given 1%, which is nothing. So that really doesn't really interest me. Why not go for fast moving markets or fast trends, right? DAX has given us 12% over the past year, which is the German index, right? And this is correlated also with S&P. So DAX is, I think, about 70 to 75% correlated with S&P, because again, the European market is correlated in one way or another. And it does follow the S&P. So if S&P is doing that, it will eventually crawl up to mimic it, but again, the pace is much slower, and the percentage returns are going to be slower, right? This is the Japanese index, right? It's called Nikkei 225. And this is much faster. And recently it's showing more of it's mimicking the S&P recently. So again, these relationships that I'm talking about between these indices, like, or the numbers that I'm giving you, these are also not static. This is like an average number, an approximation. It's not static, right? And as you can see, it looks a lot like, if you see this rally in the Japanese, it looks a lot like the S&P. But then again, remember, this market will be sensitive. So historically, it wasn't it wasn't that correlated, but now it's more correlated. So it's now more like 85% correlated. And it does depend on the Japanese yen, the exchange rate, as well as the export demand in Japan, as well as what the Bank of Japan is doing with the interest rate and its policies, right? These are some of the indices, like the important indices, and this is Euro 50. So Euro 50 is basically it tracks 50 of the largest European companies. So these 50 European companies include firms from Germany, France, Spain, Italy. Okay, so they will include companies from all over Europe, right? So like it's called Euro 50. And what has it? It's given us 8% in the last year, right? So this index is more sensitive to the European economic conditions and to the euro currency, to the banking stocks and industrial sector. And S&P is more obviously driven by the US technology companies. So again, the correlation is something like 70 to 80% with S&P. Definitely, they are all correlated. But if I look in terms of the percentage gains, let's go back and see. This is the Japanese index, which has given us, it's given us 62% in this 1 year because of this strong rally. But if you look at the historical returns, then I think, the returns have not been this high. It's like, it's a year-on-year case. The returns have not been like as consistent over time as they have been for S&P. So also Japan is a smaller economy, so yes, more susceptible to fluctuations as well. So there is a certain risk element involved here. If you have some kind of downward movement, it could be substantial, right? So that is why whichever market you want to trade, please keep in mind, if it's a leveraged position, there is no concept of going in without proper risk management and without having a stop loss in place, without knowing how much you are risking on that particular trade. Okay. So in the American indices, NASDAQ has given us 32%, S&P has given us this year 25%, which is still very, very good. And Dow again has given us 16%. So yeah, these are very interesting figures. And again, if you want to, trade in an index, yeah, I mean, it's a good idea to observe the price action daily, to look at what is the difference daily in the price action between NASDAQ, between Dow, between all these indices. And if you look at it daily, then you will start to have a more intuitive feel about the manner in which they move, about the manner in which they react to like announcements, big major news releases. And keeping all of that in mind, I can say that, after having looked at everything, I have been personally more comfortable with trading S&P because I believe that the price action, as I observe and as I've been telling you in my other webinars, that seems to be clearer in S&P and it seems to hold better. So it seems to work out better, and the stop loss placements and the structure of the price action and stop loss placements tend to be better. Maybe because it's a very big basket, maybe because of the fact that it has these 500 companies. So the price action does tend to get smoother, and then it just tends to produce better looking setups, more clearer setups. So this is one reason. I have also traded NASDAQ 100 a lot, and yeah, I have traded under other indices, but I'm giving you some of the reasons why, I like S&P. I mean, you can try trading them all. And yeah, so this is the end of the webinar, and I hope that you've enjoyed whatever I have told you. Yes, so just want to show you the correlation. So this is a slide I made about the correlation. So again, S&P and Dow have the highest, sorry, S&P and have the NASDAQ 100 have the highest correlation. And then we have Dow actually has it's a bit less than 95. It's around 85 to 90. And yeah, between S&P and the UK market, it's even lower. It's something like 70 to 75%. So what we have learned in this session is that indices are much more than just simple numbers. They represent whole economies, whole industries, whole eras of evolution, and they represent long-term wealth creation across the world. So this like remarkable growth that they show us is the power of corporate growth, is the power of compounding returns, is the power of technological advancement. And this is why indices are a very powerful instrument for you to invest and get very good returns from in the short term as well as in the long term, right? So in the next webinar, we'll be taking another step further, and we will be looking into how indices relate with each other. We'll explore the divergences and the convergences between these indices in more detail, and we will see how we can translate them into trading strategies. We'll also look at how these indices have behaved during major financial crises and how they have recovered. We will also be looking at how volatility has evolved within the indices over time. So we'll discuss practical trading strategies apart from just buy and hold, and so that you can get a more deeper understanding of the indices. And thank you so much. That's it for today. Let me just go through the questions and see if I have answered all the questions. What happened to Bitcoin? Okay, let me just uh, go to the Bitcoin chart. I have a question. How do you know which is the best S&P to invest in? There are so many. Actually, the thing is, like I said, if you're a beginner and you don't know how to trade properly, you don't know how to time your entries, it's better to go with an ETF, which we have here on the platform, and a request for zero leverage. So you will not have any leverage. So this is the instrument if you're a complete beginner and you don't want very high returns, but high risk, then you can trade this SPY. Here, this is an ETF basically. So, and this you can request for zero leverage on this. So you will just be holding the actual value of this. But if you think that you can trade and you understand how to use margins and leverage and you understand how to do some risk management and all that, then you can trade the spot index, which is SPX 500. But remember that if the position is open overnight, you will have some financing or swap charges for the overnight position, right? So if you close the position before 24 hours, you will not have any charges. If you want to keep the position open, then the best is this one, the E-mini SP6M, which is the futures contract. So if you keep the position open overnight, they're all the same, right? But it just depends on your preference. If you want to keep the position overnight, you also want to take leverage, you might want to short as well, because in non-leveraged situation, shorting, you cannot you can only go long, you can't go short. Yeah, so if you want to keep the position open overnight, then you should trade this in futures. I hope that answers your question. And yeah, what happened to Bitcoin? I don't think anything happened to Bitcoin. I think it's proceeding the way it should have. Bitcoin. By the way, I have some people asking me if we can get the recordings of the webinars. So these recordings are uploaded on our YouTube channel. So Amana has a YouTube channel, and you can find the recordings of all the past webinars. And this webinar too will be uploaded there. Okay. Yes, so it looks very good to me. I don't think there is anything wrong with it. Yes, so it is basically like I discussed before about Bitcoin in the webinar on allocating between commodities and crypto, that it has started to show bullishness, and it's not in a very strong or aggressive bullish rally, but definitely Bitcoin is turning bullish, and it is making multi-week highs as we observe. So always be on the daily time frame to look at the bigger macro trend. And yes, so since here we have this double bottom with this bottom slightly above the previous one, it's a very strong bullish signal on the higher time frame. And yes, I feel that the market is overall bullish. And what could be a possibly good entry here? Look for strong bullish price action signal at this particular level that we are right now. If you find a strong bullish price action signal, such as a bullish engulfer, such as a bullish inside bar, such as a downward wicked candle with a long wick right on this level, that could actually signal that strong buying pressure is developing here on this level. I don't usually recommend blind entries. I will always look for a confirming price action signal and then enter. So actually, we have gone beyond time, and there are some questions which my colleagues will answer, and I will see you in the next webinar. Thank you so much for attending.